Welcome to the lecture on partnership accounting. In this lecture, we will discuss about retirement of a partner, calculation of new ratio, and gain ratio, treatment of goodwill, a partner can be retired due to age, misunderstanding among partners, loss in a business, starting a new venture. So, a partner may retire due to his age, misunderstanding among partners, loss in business, or starting a new business. At the time of retirement, the retiring partner, that is, the outgoing partner, will take away his capital, his share of profit or loss, up to the date of retirement, and reserve and surplus. Reserve and surplus is the undistributed part of profit which has been added to the capital for further growth and development of the business. So a retiring partner will take away his part of capital, his share of profit or loss till the date of retirement, and reserve and surplus, his share of reserve and surplus. Conditions of retirement. First point, he has to provide notice to all the remaining partners, at least 14 days notice, or he can retire as per the agreement in accordance with agreement among partners and with the consent of all the partners. Consent of all the remaining partners is required at the time of retirement. So, a retiring partner will take away his part of capital, his share of profit and loss, and reserve and surplus, if any. Condition of retirement, at least 14 days notice to the remaining partners, or he may retire in accordance with the agreement. The terms and conditions are written in the partnership deed, and consent of all the remaining partner is required. Now let's start with the calculation of new ratio. A, B, C share profit and losses in the ratio of 4 is to 2 is to 1. There are three partners, A, B, and C. Their old ratio is 4 is to 2 is to 1. If B retires, Mr. B retires, what will be the new ratio? If B retires, then his share of profit will be cancelled. So remaining partner will be A and C, and new ratio will be 4 is to 1. Old ratio 4 is to 2 is to 1 among partner A, B, and C. At the time of retirement of partner B, his share of profit will be ignored and new ratio will be 4 is to 1. 4 is to 1 among A and C. Next, X, Y, and Z share profit and losses equally. Old partners are X, Y, Z. Old ratio is equal 1 is to 1 is to 1. Z retires. Mr. Z retires from the business and his share is acquired by X and Y in the ratio of 3 is to 1. So, Mr. Z's share will be distributed among remaining partners in the ratio of 3 is to 1. Calculate new profit sharing ratio. So, first we have to multiply the old ratio with this share. So, for Mr. X, old ratio multiply by 3/4. 3 is to 1 means for Mr. X, this is 3/4 share, and for Mr. Y, old ratio into 1/4 share, 1/4. So old ratio of Mr. X is 1/3 multiplied by 3/4. To get equal denominator, we have to multiply with 4 and this with 3. So we will get 1 into 3, 3 divided by 4 into 3, 12. And in case of Y, old ratio is 1/3 multiplied by 1/4. Again, to get same denominator, 1 into 1, 1 divided by 4 into 3, 12. Now, to get new ratio of Mr. X, we have to add old ratio with his additional share 3/12. This is the share of Mr. Z which is distributed among remaining partners in 3 to 1. Old ratio is 1/3 plus additional share, that is 3/12. Again, to get same denominator, we have to multiply this by 4 and 12 with 1. 4 into 1, 4 plus 3 into 1, 3. 7/12. New ratio of Mr. X is 7/12. Similarly, for Mr. Y, we will calculate for Mr. Y. Old ratio plus additional share. Old ratio is 1/3 plus additional share is 1/12. To get same denominator, we have to multiply with 4 and 12 with 1. 4 into 1, 4 plus 1 into 1, 1 divided by 12. So 4 plus 1, 5 divided by 12. New ratio of Mr. Y will be 5/12. New ratio of Mr. X is 7/12 and Mr. Y is 5/12. So new ratio is 7 is to 5. We can also calculate by way of this the total ratio. The total share is 12 minus X share 7. So remaining share will be 5. So 7 is to 5 is the new profit sharing ratio between X and Y. Now let's start with calculation of gain ratio. A, B, and C are partners sharing profit and losses in the ratio of 4 is to 3 is to 2. A, B, C are old partners. Their old ratio is 4 is to 3 is to 2. B retires. B retires. So remaining partner will be A and C. They share future profit equally. New ratio is given among A and C 1 is to 1. Calculate gain ratio. We know the formula gain ratio equals to new ratio minus old ratio. So gain ratio for Mr. A will be new ratio, that is 1 by 2 minus old ratio 4 plus 3 plus 2 9, 4 divided by 9. Now to get same denominator we will multiply with 9 and this by 2. Now 9 into 1 minus 4 into 2, the 9 minus 8, 1 by 18. And for Mr. C, new ratio is 1 by 2 minus old ratio is 2 by 9. 9 into 1, 9 minus 2 into 2, 4. Balancing figure will be 5 by 18. So gain ratio among A and C is 1 is to 5. So gain ratio equals to new ratio minus old ratio. Remember, at the time of admission, the sacrifice ratio was old ratio minus new ratio. At the time of retirement, as well as at the time of death, the gain ratio will be new ratio minus old ratio. So both the ratios are given in the question, new old ratio as well as new ratio. So new ratio minus old ratio, we will get gain ratio. Next, X, Y, and Z are sharing profit and losses in the ratio 4 is to 3 is to 2. X, Y, Z are old partners. Their old ratio is 4 is to 3 is to 2. Z retires. The new ratio of X and Y is 3 is to 2. Z retires and new ratio is 3 is to 2 among X and Y. Calculate gain ratio. Gain ratio equal to new ratio minus old ratio. For Mr. X, new ratio is 3 by 5 minus old ratio is 4 plus 3 plus 2, 4 by 9. To get same denominator, we will multiply 5 with 9 and 9 with 5. 9 multiplied by 3, 27. 5 multiplied by 4, 20. The balancing will be 7 by 45. The gain ratio of Mr. X is 7 by 45. And for Mr. Y, new ratio 2 by 5 minus old ratio 3 by 9 9 multiplied by 2 minus 5 multiplied by 3 balancing 3 by 45. So gain ratio is 7:3. Gain ratio among X and Y is 7:3. Next, P, Q and R are partners sharing profits in the ratio 2:2:1. P, Q and R are old partners sharing profit and loss in the ratio 2:2:1. Q retired, Mr. Q retired, so new partner will be P and R. Calculate gain ratio. In case no additional information about new ratio is given, then we will assume that the retiring partner's share will be cancelled and new ratio will be 2:1 between P and R. The share of Q, the retiring partner, will be cancelled. So new ratio will be 2:1. So gain ratio will be equal to new ratio minus old ratio. For Mr. P, new ratio is 2 by 3 minus old ratio is 2 plus 2 plus 1, 2 by 5. Then 5 multiplied by 2, 10 minus 2 multiplied by 3, 6, 4 by 15 for Mr. P, and for Mr. R, new ratio is 1 by 3 minus old ratio is 1 by 5. 5 into 5 into 1, 5 minus 3 into 1, 3, 2 by 15, 2 divided by 15. So gain ratio is 4:2, 4:2, that is 2:1. Gain ratio is 2:1. Next, treatment of goodwill in case of retirement. There are two cases. If goodwill is raised, then journal entry will be goodwill account debit to old partner's capital account, and amount will be distributed in old ratio. And if goodwill is written off, then along with this entry, one more entry will come, that is new partner's capital account debit to goodwill account, and amount will be distributed among new partners in new ratio. So remember, old partners old ratio, new partners new ratio. New partners will be remaining partners in case of retirement. For example, A, B, C, three partners are there and goodwill is raised, then Goodwill account debit to old partner's capital account to A, B, and C capital account. If Mr. C is retired from the business, then new partners will be Mr. A and B. After reconstitution, the new partners will be A and B. Remaining partners are new partners. So, at the time of return of goodwill, the journal entry will be new partners capital account debit, that is A and B capital account debit to goodwill account, and amount will be distributed in new ratio. And if the question is asked that goodwill is to be raised only up to the share of retiring partner. If question specifically says that raise the goodwill only by the share of retiring partner, then the entry will be goodwill account debit to retiring partner capital account. If goodwill is already present in the balance sheet, then only differential amount will be transferred to revaluation account, or profit and loss adjustment account. Both are same, and second effect will be partners capital account or partners current account. If fluctuating capital method is followed, then entry will be passed in partners capital account, and if fixed capital method is followed, then the entry for goodwill will be passed in partners current account. Now let's start with the illustration. Given below is the balance sheet of Ram, Lakshman and Bharat, who are partners in a firm sharing profit and losses in the ratio 5:3:2. Old partners are Ram, Lakshman and Bharat, and old ratio is 5:3:2. Their balance sheet as on 31st March 2022 was as follows. Balance sheet asset side and liability side are given. Cash, debtors, stock, machinery, land and furniture. On liability side, creditors, bank overdraft, reserve fund. It will be distributed among old partners in old ratio, because retiring partner will also take away his share of reserve fund, and capital account of all the partners are given. On 1st April 2022, Bharat retired on the following terms. Mr. Bharat retired from the business on 1st April 2022. Goodwill of the firm will be raised in the books at 20,000 rupees. Remember, at the time of raising the goodwill in the books of accounts, the journal entry will be goodwill account debit to old partners capital account. Stock be reduced by 10%, stock, and furniture by 5%. There are adjustment in stock, furniture and machinery. Machinery will be reduced by 11%. So the amount will be recorded in inner column. The reserve for bad and doubtful debt be maintained at 5% on debtor. There is adjustment in debtors also. So 5% will be reduced from debtors, and second effect of all the entries will be on revaluation account debit side. Fourth point, 200 rupees to be written off from the creditors. There is adjustment in creditor also, so amount will be recorded in inner column. And last point, Out of the amount due to Bharat, 5,000 rupees to be paid by cash and remaining amount to be transferred to his loan account. So Bharat is retiring from the business, so he will take away his part of capital also, and the condition is given that 5,000 rupees will be paid in cash immediately. Out of the portion belongs to Bharat, 5,000 rupees will be paid in cash and only remaining part will be transferred to his loan account. So we have to create another account, that is Bharat's loan account. Prepare profit and loss adjustment account. It is also called as revaluation account, partners capital account, and balance sheet of a new firm. Balance sheet of new firm means balance sheet after retirement. So old ratio is given between Ram, Lakshman and Bharat. Old ratio is 5:3:2. No information about new ratio is given. So we will assume that new ratio will be 5:3 between Ram and Lakshman, because Bharat is retiring partner. So his share of goodwill will be cancelled. So old ratio is 5:3:2. New ratio is 5:3. So in the books of partnership firm, profit and loss adjustment account, debit side and credit side. On the debit side, we will record all types of expenses and losses, reduction in value of assets, and increase in value of liability. On the credit side of profit and loss adjustment account, we will record all types of income and gain, and increase in value of assets or decrease in value of liabilities. Next is partners capital account, debit side, credit side. Next, balance sheet as on 1st April 2022, that is after retirement. So let's start with the first balance sheet. Asset side, cash 7,600 is given. So we will record cash at the end after recording all the entries. Debtors 18,000 rupees. There is adjustment in the debtor, so we will record in the inner column. Stock 17,500. Machinery 30,000 rupees. Land 70,000 rupees. There is no adjustment in land, so we will record in outer column. Furniture by 5,000 rupees. Furniture of rupees 5,000. On the liability side, creditor is given 11,200. It is normal practice to write partner's capital account first on the liability side for better presentation, and later on we will write all other types of liabilities. Bank overdraft 9,700. We don't have any adjustment for bank overdraft, so we will record in the outer column. Reserve funds will be distributed among old partners in old ratio, that is 5:3:2. So 15,000 rupees will be distributed among partners in the ratio 5:3:2. So reserve fund will be on partners capital account credit side, because liabilities have credit balance. So partners capital account credit side, reserve fund, total reserve fund is 15,000. 5 by 10, 7,500 rupees for Mr. Ram. 15,000 into 3 by 10, the share of Mr. Lakshman is 3 by 10. Amount is 4,500, and 15,000 into 2 by 10, 3,000 rupees for Mr. Bharat. 5:3:2. We have distributed reserve fund of 15,000 rupees among old partners Ram, Lakshman and Bharat in old ratio, that is 5:3:2. Partners capital account Ram, Lakshman and Bharat 42,000, 37,000, 33,200 respectively. So it will come on partners capital account credit side by balance brought down, that is opening balance 42,000 Ram, 37,000 Lakshman, 33,200 for Bharat. Now adjustment number 1. Goodwill of the firm will be raised in the books at the rate 20,000 rupees. So goodwill raised and it will be distributed among old partners for 20,000 rupees. So at the time of raising the goodwill, the treatment of goodwill will be goodwill account debit to partners capital account, old partners capital account in old ratio. So 20,000 rupees will be distributed among old partners in 5:3:2. So partners capital account on credit side by goodwill account 20,000 into 5 by 10. 10,000 rupees is the share of Ram, 20,000 into 3 by 10. 6,000 is the share of Lakshman, and balancing 4,000 rupees is the share of Bharat. And second effect will be on balance sheet asset side, goodwill is raised by 20,000 rupees. So first effect, partners capital account credit side by goodwill account, and balance sheet asset side goodwill. First entry is over. Second adjustment, stock be reduced by 10%. Stock is reduced by 10%. So 10% of 17,500 is 1,750 rupees. It will be reduced 17,500 minus 1,750. Balancing figure 15,750 will be on outer column. Stock 17,500 minus 10% depreciation or reduction in stock. Balancing figure will be on outer column 15,750. Furniture is reduced by 5%. Depreciation in furniture by 5%. 5% of 5,000 rupees is 250 rupees. Balancing figure 4,750 rupees in the outer column. And machinery by 11%. 30,000 rupees is the value of machinery. So 30,000 into 11%, 3,300 will be reduced from machinery. Balancing figure 26,700. on the outer column. So adjustment is reduction in value of stock, furniture and machinery. So we will reduce the amount from respective assets, and second will be on profit and loss adjustment account debit side, because the value of asset is decreasing. It is a kind of notional loss. So stock 1750, the amount of stock reduction in stock is 1750. Furniture 250, machinery 3300. Third adjustment, reserve for bad and doubtful debt we maintain at 5% on debtors. The value of debtors is 18,000 rupees and reserve for doubtful debt is 5% on 18,000 rupees. So amount will be 18,000 into 5%, that is 900 rupees, and balancing figure 17,100 will be in the outer column. And second effect will be on profit and loss adjustment account debit side 900 rupees. Clear? Fourth, fourth adjustment 200 rupees to be written off from the creditors. Now write off means reduce, deduct the amount from creditor 200 rupees, write off from creditors, and balancing figure 11,000 rupees in the outer column. Reduction in value of asset is on profit and loss account debit side. So reduction in value of liability will be shifted to profit and loss adjustment account credit side. So profit and loss account credit side by creditors account 200 rupees. And the last adjustment, out of the amount due to Bharat, 5,000 rupees to be paid by cash. Cash of 5,000 rupees paid to partner Bharat. So the entry will be Bharat capital account debit to cash account, because Bharat is the receiver of the cash, debit the receiver, and cash is going out, credit code goes out, so cash account will be credited. Bharat account debit to cash account, we will write on partner's capital account debit side to cash account in the column of Bharat 5,000 rupees paid in cash, and remaining amount to be transferred to his loan account. So balancing amount will be transferred to his loan account. Now first we will close profit and loss adjustment account. Debit side is more. So total of debit side is 1750 plus 250 plus 900 plus 3,300. Amount is 6,200. It will be shifted to credit side 6,200 minus 200 rupees creditors. Balancing figure will be 6,000 rupees, and this 6,000 rupees will be distributed among old partners in old ratio, that is 5:3:2 by partners capital account Ram, Lakshman, Bharat. So 6,000 rupees will be distributed among Ram, 6,000 into 5 by 10, 3,000 rupees for Mr. Ram, 6,000 into 3 by 10 for Mr. Lakshman, 1,800 rupees, and balancing 1,200 rupees for Mr. Bharat. From from profit and loss adjustment account credit side to partners capital account debit side, this is the revaluation loss. It will be shifted to partners capital account debit side. Ram 3,000 rupees, Lakshman 1,800 rupees, and Bharat 1,200 rupees. Now partners capital account credit side is more. We will cast the total of Mr. Ram 42,000 plus 7,500 plus 10,000 rupees, 59,500, 37,000 plus 4,500 plus 6,000 rupees, 47,500, 33,200 plus 3,000 plus 4,000, 40,200. It will be shifted to debit side. Balancing figure of Mr. Ram 59,500 minus 3,000 rupees, 56,500, 47,500 minus 1,800, 45,700, and balancing figure of Mr. Bharat will be shifted to his loan account as given in the adjustment number 5. Remaining amount to be transferred to his loan account. So remaining amount is 40,200 minus 1,200 minus 5,000 rupees. So 40,200 minus 1,200 minus 5,000. Balancing figure is 34,000 rupees. So this balancing figure, the closing balance of partner's capital account to balance carried down of 56,500 of Mr. Ram and 45,700 for Lakshman will come on liability side. Total amount will be in the outer column 56,500 plus 45,700, 1,02,200, and the amount of Bharat loan account 34,000 will be recorded separately. Now the amount of cash will be 7,600 minus 5,000 rupees paid to Bharat. So balancing figure is 2,600. 7,600 minus 5,000 rupees paid to Bharat. Balancing figure 2,600 will be in outer column. So asset side and liability side total will be 1,56,900 on liability side, and asset side 1,56,900. Total will be equal and balance sheet is tallied. So in the question, old ratio among old partner is given, assets and liability side is given, adjustment is given, and we have to prepare profit and loss account, partners capital account, and balance sheet after retirement. So first we have to prepare profit and loss adjustment account. The balancing figure will be distributed among old partners in old ratio, and it will be then shifted to partners capital account opposite side. From profit and loss account credit side, it will be recorded on partners capital account debit side to profit and loss adjustment account. Ram 3000, Lakshman 1800, Bharat 1200. And then balancing figure, the closing balance of partners capital account will be recorded on the liability side, and Bharat's loan account will be created separately, and balance sheet assets and liabilities amount will be equal. Next illustration, following is the balance sheet of the firm of Amit, Jitu and Rishi, who share profit and losses in the ratio of their capital. So capital of Amit, Jitu and Rishi is 50,000, 20,000 and 30,000 rupees. So old partners are Amit, Jitu and Rishi, and their old ratio is similar to their capital. So 5 is to 2 is to 3. The old ratio is 5 is to 2 is to 3. The old ratio is in the ratio of their capital, and their capital is 50,000, 20,000, 30,000. So their ratio is 5 is to 2 is to 3. Now balance sheet as on 31st March 2022 is given. Asset side, machinery, building, stock, debtors, less RDD and cash balance is given. On the liability side, capital account of old partners, that is Amit, Jitu and Rishi is given. Creditors and bills payable. Rishi retires from the business. Now Rishi retires from the business on 1st April 2022, and the following adjustments were carried. First point, stock is to be valued at 92% of its book value. Book value means the price which is recorded in the balance sheet, 12,000 rupees. We will assume that it is recorded at the rate 100%, and stock is to be valued at 92% of its book value. So we have to bring it down to 92%. So we have to reduce 8% from 12,000 rupees. Next, RDD is to be maintained at 10% on debtors. So debtor is 12,000 rupees. RDD will be 10% on debtors. So 12,000 into 10%, that is 1,200, and additional reserve for doubtful debt is to be created. The value of building to be appreciated by 20%. There is adjustment in building, so it will be recorded in inner column. The goodwill of the firm be fixed at 12,000 rupees. Goodwill of the firm is 12,000 rupees. Rishi's share in the same be adjusted in the account of continuing partners in gain ratio. So Rishi's share in the goodwill, that is 3/10, will be distributed among remaining partners in the gain ratio. So we know the journal entries. First we have to raise the amount of goodwill up to the share of Rishi. Then we will distribute among remaining partners in gain ratio. Next, the entire amount of capital of the new firm be fixed at 1,60,000 rupees between Amit and Jitu. So after retirement, the remaining partner, that is Amit and Jitu, will bring capital in the ratio of their new ratio, in their new profit sharing ratio, which is fixed at 3 is to 1. New profit sharing ratio is also given, that is 3 is to 1 between Amit and Jitu, and new capital will be 1,60,000 rupees total. So we have to increase the amount of capital of Amit and Jitu, and total of 1,60,000 rupees will be in the outer column. Making adjustment in cash. So Amit and Jitu will bring additional capital in the form of cash, and amount of cash will be increased. Sixth point, the amount payable to Rishi is paid in cash. The remaining balance, that is capital plus profit or loss up to date of retirement, will be paid in cash to Mr. Rishi. So important adjustment will be goodwill and capital. Prepare revaluation account, that is profit and loss adjustment account, partners capital account, and balance sheet as on 1st April 2022. The given balance sheet is as on 31st March 2022. That is old balance sheet. We have to prepare new balance sheet as on 1st April 2022. So old ratio is 5 to 2 to 3 and new ratio is 3 to 1. First we will calculate the gaining ratio. So Amit, Jitu and Rishi, old partners, their old ratio is 5 to 2 to 3, and new ratio between Amit and Jitu is 3 to 1. So gain ratio will be equal to new ratio minus old ratio. Gain ratio of Mr. Amit is new ratio, that is 3 by 4 minus old ratio, that is 5 divided by 5 plus 2 plus 3, 10. So we have to multiply by 10 and this by 4. Denominator will be 40. 10 by 10 into 3, 30, minus 5 into 4, 20. 10 by 40, and gain ratio of Mr. Jitu will be new ratio, that is 1 by 4, minus old ratio, that is 2 by 10, ten into 1, 10, minus 4 into 2, 8, so 2 by 40. 10 by 40, 2 by 40, that is 10 is to 2 or 5 is to 1. Gain ratio is 5 is to 1. Old ratio is 5 is to 2 is to 3. New ratio is 3 is to 1. And gain ratio is 5 is to 1. So goodwill will be distributed among remaining partners in the ratio 5 is to 1. So let's start with solution. In the books of the firm, revaluation account, partners capital account, Amit, Jitu and Rishi, and balance sheet as on 1st April 2022 is prepared. We will start with balance sheet. Asset side, machinery 20,000 rupees. Machinery 20,000 rupees. Balance sheet assets. Building 55,000 rupees. Building 55,000 rupees. Stock 12,000 rupees. Debtors 12,000 rupees. RDD will be recorded at the time of adjustment and cash will be recorded at the end. Liability side, capital account, Amit, Jitu and Rishi 50,000, 20,000, 30,000 rupees. So partners capital account credit side, by balance wrote down. The opening balance of capital is 50,000 rupees, 20,000 rupees and 30,000 rupees. Creditors 10,000 rupees and bills payable 5,000 rupees. Creditors 10,000 rupees, bills payable 5,000 rupees. Now adjustment number 1, stock is to be valued at 92% of its book value. So we have to reduce stock by 8%. 12,000 into 8%, 960 rupees will be deducted from stock and balancing figure of 11,040 rupees will be on outer column. RDD is to be maintained at 10% on debtors. So 12,000 into 10%, 1,200 will be reduced and balancing figure of 10,800 will be on the outer column. In the balance sheet, RDD is 1,000 rupees given. We have to increase RDD by 200. So we will record on revaluation account debit side 200 rupees RDD. We only have to record the difference between old RDD and new RDD. Stock is reduced by 960 rupees. So revaluation account debit side to stock account 960, to reserve for doubtful debts account 200 rupees. If value of asset decreases, we will record it on revaluation account debit side. If value of asset increases, it is a kind of profit, therefore it will be recorded in revaluation account credit side. On the contrary, if value of liability increases, it will come on revaluation account debit side because it is a kind of notional loss, and if the value of liability decreases, it will be recorded on revaluation account credit side. Now, third adjustment, the value of building is to be appreciated by 20%. Appreciation in building will be added to building account. Appreciation means increase in value by 20%. So 20% of 55,000, 11,000 rupees will be added. Total will be 66,000. Increase in value of assets will be recorded on revaluation account credit side 11,000 rupees. Fourth entry, goodwill of the firm be fixed at 12,000 rupees and Rishi's share in the same be adjusted in the account of continuing partners in gain ratio. So first we will calculate Rishi's share in goodwill. 12,000 rupees is the goodwill of the firm. So we have to calculate Rishi's share in 12,000 rupees. So Rishi's share is 3 by 10. So 12,000 into 3 by 10, 3,600 rupees will be recorded first on partner's capital account credit side in receipt column, and now it will be adjusted in the account of continuing partners. Continuing partners are Amit and Jitu, and it will be distributed in gain ratio. So gain ratio is 5:1. So 3,600 into 5 divided by 6. 3,000 rupees will be recorded in Amit column. 3,000 rupees and 600 rupees balancing figure will come in G2 column. So goodwill is raised up to the share of retiring partner. Entry will be goodwill account debit to Rishi capital account, and then it is distributed among remaining partners in gain ratio, that is 5:1. So 3,600 is distributed by 3,600 respectively in Amit and Jitu account. So this part is important. Goodwill account, creation of goodwill, that is raising of goodwill, and it will be distributed or written off among continuing partner in gain ratio. Next, fifth adjustment, the entire capital of new firm will be fixed at 1,60,000 rupees between Amit and Jitu in their new profit sharing ratio. So, balance sheet, liability side, capital account of Amit and Jitu, total amount is 1,60,000 rupees, and it will be recorded, it will be distributed among both the partners in new ratio, and new ratio is 3:1. So 1,60,000 into 3 by 4, 1,20,000 rupees is the amount of Amit, and balancing 40,000 rupees will be part of G2. Second effect will be partner's capital account debit side, two balance carried down. This is the closing balance of capital. One lakh 20,000 rupees Amit and 40,000 rupees Jitu, nil for Rishi, and it is said that balancing amount will be adjusted in cash. We will record cash at the end. Amount payable to Rishi paid in cash. Let's check amount payable to Rishi. First calculate revaluation account. Total credit side is more 11,000 rupees. So it will be shifted to debit side, and balancing figure, that is 11,000 minus 960 and 200, Balancing figure 9,840 will be distributed among old partners in old profit sharing ratio. Revaluation account credit side is more and we record profits on credit side. So if profit is more, then balancing figure will be revaluation profit. It is distributed among three partners in their profit sharing ratio 9840 into 5 by 10. Amit's share is 5 by 10, 4920. 4920, 9840 into 2 by 10, 1968. G2 capital and balancing figure 9840 into 3 by 10, 2952. Rishi's capital. Total will be 9,840 rupees. Now revaluation profit will be shifted to partners capital account credit side by profit and loss adjustment account 4,920 in Amit column, 1,968 in G2 column, 2,952 for Rishi column. Now debit side of Amit column is more. Total is 1,23,000 and debit side of G2 column is also more than credit side. So both the amount will be shifted to credit side. Then the balancing figure will be contributed by each partners in cash because adjustment number 5 says that the balancing figure will be adjusted in cash. So the required amount of capital will be brought in by new partners in cash. So 1,23,000 minus 50,000 minus 4,920 will be 68,080 rupees. 40,600 minus 20,000 minus 1968. 18,632 and credit side of Rishi account is more. Total is 30,000 plus 2,952 plus 3,600 36,552. So this amount of Rishi capital will be shifted to debit side and it will be paid in cash because adjustment number 6 says that amount payable to Rishi paid in cash. So the balancing figure of Rishi capital account will be paid in cash. Now the amount of cash is 17,000 rupees. We have to add this to amount of cash because Amit and Jitu bought in as a capital and we have to reduce the cash by 36,552 because the amount is paid to Rishi. So 17,000 rupees opening balance of cash plus amount brought by Amit 68,080 rupees plus amount brought by G2 18,632 minus amount paid to Rishi 36,552 67,160 rupees will be amount of cash. 67,160 rupees cash. So we have done with all the adjustment. Now we will add. Now we will calculate the total of assets and liability side. 1,75,000 rupees is the total of assets and 1,75,000 rupees total of liability side. So we have prepared revaluation account. Balancing figure is distributed to old partners in old ratio and it is shifted to opposite side of partners capital account, that is from debit side of revaluation account to credit side of partners capital account. Then balancing figure is adjusted in cash as given in the adjustment and balance sheet is tallied. Important point in this illustration was goodwill was raised up to the part of retired partner and it is then distributed among remaining partner in gain ratio. And second point, closing capital is given in the question. We have to adjust the capital by cash. New partners bring 68,000 and 18,632 respectively to increase the value of capital and balance sheet is then tallied.